You ever notice how everyone thinks they're a great investor? Right up until the market humbles them? Maybe you've been there. You put in $5,000, watch it grow to $6,200, and you start thinking, wow, I'm a natural at this. Then 2 weeks later, it's $4,100, and you're staring at your phone wondering where it all went. The truth is, most people fail at investing, not because they're stupid, but because they don't understand the game they're playing. A recent study showed that the average retail investor underperforms the S&P 500 by about 4% per year. That might not sound like much, but over 20 years, it's the difference between ending up with $80,000 or $130,000 from the same $20,000 starting point. The worst part? Most of these failures are preventable, but people keep making the same mistakes over and over again. Let's talk about the three biggest reasons people fail at investing. And trust me, I've been guilty of all three at some point. Reason number one: emotional decisions, fear and greed. They're like the twin destroyers of wealth. You buy when everyone's excited and prices are sky high, then you panic sell when things drop. I've seen people put $10,000 into a sure thing at the top, watch it fall to $6,000, panic, and sell, only to see it rebound back to $11,000 a month later. They lock in the loss and miss the recovery. Reason number two: no strategy. This is where most people really get burned. They're basically driving without a map. One week it's tech stocks, the next it's meme coins, then it's real estate crowdfunding. No plan, no system, just chasing whatever's hot. Imagine trying to build a $100,000 portfolio like that. You'd be lucky to even keep your original $10,000 after a few years of that chaos. Reason number three: ignoring risk management. This is the silent killer. People think they're diversifying because they own 5 different stocks, but they're all in the same industry. Or they leverage too much, turning $5,000 into $15,000 of buying power, which is great until the market drops 10% and suddenly that $5,000 is gone. Plus, you owe your broker money. That's how people blow up accounts overnight. Bottom line, these three mistakes: emotion, no strategy, poor risk management, account for probably 80% of the money lost by regular investors every single year. Here's where it gets tricky: the psychological traps that turn smart people into bad investors. First, the herd mentality. You see everyone piling into the same stock or crypto and you think, if they're all in, I must be missing out. That's how people bought Bitcoin at $68,000 in 2021, only to watch it crash to $20,000. If you put in $50,000 at the top, you were suddenly staring at a $30,000 loss. Then there's overconfidence. You make a few good trades, maybe you turned $2,000 into $3,500, and suddenly you think you're Warren Buffett. You start increasing your positions, taking bigger risks, and ignoring your own rules. One bad week later, that $3,500 is down to $200, and you're wondering what happened. And of course, panic selling. This is when you see your portfolio drop 15% in a few days and you hit the sell button just to stop the bleeding. But if the market bounces back right after, you've locked in the loss. I've seen people sell $80,000 worth of stocks in March 2020 during the COVID crash, only to watch those same stocks double in value within 18 months. That's missing out on $80,000 in gains because of fear. These traps aren't about intelligence, they're about emotion. The market is a giant psychological game, and if you can't manage your emotions, you're going to lose. Now let's look at the data, because numbers don't lie. Over the last 30 years, the S&P 500 has averaged around 10% annual returns. That means if you put $10,000 into an index fund and left it alone, it would have grown to over $175,000 without you lifting a finger. Here's the crazy part. If you missed just the 10 best days in the market over those 30 years, your return would be cut almost in half. Instead of $175,000, you'd end up with around $90,000. That's the cost of panic selling and trying to time the market. Look at the 2008 financial crisis. If you had $50,000 in the market at the peak, it might have dropped to $25,000 at the bottom. Most people sold there out of fear, but those who stayed in saw that $25,000 grow to over $80,000 within 5 years as the market recovered. Or take March 2020. The COVID crash wiped out trillions in market value in weeks. People who sold locked in their losses. But those who held on or even bought more saw gains of 50%, 70%, even 100% in less than 2 years. The data proves it. The biggest gains happen when most people are too scared to stay invested. Patience isn't just a virtue in investing, it's money in your pocket. So, how do you avoid becoming another failed investing statistic? It starts with having a plan before you put a single dollar into the market. Rule number 1: build your strategy first. Decide how much you're investing, what you're investing in, and how long you're willing to hold. If your plan is to turn $5,000 into $20,000 over 10 years, you can't abandon ship after the first bad month. Rule number 2: set buy and sell rules. For example, only buy when a stock is undervalued by 20% or more compared to its historical average, or sell only if the fundamentals of the company change, not because the price dips for a week. Rule number 3: manage your risk. Don't put more than 10% of your total portfolio into a single stock or asset. That way, if one $2,000 position goes bad, you're not losing half your net worth overnight. And finally, learn to sit tight. Some of the best investors in history made their fortunes by simply holding great assets through the noise. Remember, if you put $10,000 into the right investments and let them compound at 10% a year, you'll have over $67,000 in 20 years without touching a thing. At the end of the day, investing is less about finding the next big thing and more about avoiding the big mistakes. Most people fail not because they picked the wrong stock, but because they couldn't stick to the right plan. If you take nothing else from this, remember this: discipline beats hype. Every single time. If you got value from this video, hit that subscribe button, drop a comment with your biggest investing mistake, and share this with someone who's about to make one. Your future self will thank you.